Hello, friends, and welcome to my YouTube channel Simply Stocks. And today I'm going to talk about DMART. Has it formed a bottom that we found recently, or is it a time where one should avoid it and it could go down even more? So let's get started. First of all, disclaimer that this is not a stock recommendation. People taking any position to any share that I talk about should that with your own due diligence and research, and I'm not in favor or against any company that I talk about. Before I talk about DMART, a small request to kindly support me on Patreon. Once you do that, help me grow the channel, help you also ask me questions and eke out answers in greater detail. Once you get a $10 membership, you will have access to my portfolio, my watch list, and number of podcasts I put up from time to time. And also, if you get $100 upfront, you get 1 year access by paying for 10 months. For detailed market or company talk, you can directly email me and we can work things out with a fee. And also, you cannot pay on Patreon, you can take the YouTube or the WhatsApp membership. Now, about the company, DMART was formally established in 2000 and they are focused on providing consumer products in a retail space. And it is a leader in organized retail business with higher margins and lower cost. Have multiple retail malls, especially in south of India or West India. Backed by market guru Radhakrishnan Damani, it is one of the most profitable retail houses of India. In fact, the most profitable, and it has most of its, you can say, stores owned by the company itself rather than having it leased. In terms of the financials, these are Q4 numbers. So sales went up by 18%, which is pretty good, but eventually the final profit number was only 3.2% higher. Although, if we look at gross profits or you can say operating profit, that came out to be higher by around 25%. So that was quite decent, around 22% increase in gross profit, but with higher expenses, etc., and other expenses and so on and so forth, plus taxes and more, we ended up with a very lesser number in terms of very less number in terms of the final profits. It's a zero debt company. The ROE is around 11.5%. Margins have dipped to 8% from around 10-11%. And margins have dipped for most of the companies, as you would understand, across the board. So lower taxes boosted numbers last time around, but not this time around. Last year, the numbers were better off because of lower taxes, but this time around there were higher taxes, there were higher expenses, other expenses, etc., depreciation, which led to lower profits on the bottom line. In terms of what lies ahead for the company and where could we see it, so the business is only picking up at the moment. You need to understand that during the pandemic the business did not do that well, and over the last 2 3 years it hasn't done much in terms of sales and profitability. But it's commendable that the margins have not fallen a lot. So it has fallen from around 10 to 11% to around 8%, but it has not gone down sharply, or the company has not made a lot of, you can say, company has not gone into very less profitability from high profits that we saw earlier. At a growth rate of around 30-35% CAGR, set to double earnings every 2 years. I believe if we take FY24 earnings as to where it is, around 23-24 rupees, I think over after FY23, by FY25 we could have earnings closer to around 50 rupees, and a target of around 5500-6000 is very much possible even at 110-120 times earnings. So I'm looking at by 2024 May around 5500 rupees, where the earnings would be around 47-48 rupees. The stock could be trading at 115 times. Remember that the growth rate should come back once things completely normalize and things pick up across the board. So much better consumer sentiment only mean better earnings. So going forward, it would be that. So if not 2024, but by 2025, you would see the stock double from here. So I think in the next 3 years, you could see the stock going to 6,000, 6,400 levels, closer to even 7,000 in the next 3 years. I think things should pick up and then the valuations will expand in terms of PE as well. You need to understand that higher PE stocks or higher growth stocks with higher PE have shrunk. The stock like DMART used to command a PE of even 180, 200 at one point of time. It has got reduced and it has gone to a level of around 110 or so during the time when the stock fell to around 3200. The stock was trading at 110 times. So I would say that the earnings should expand over 3 years, could double over 3 years, and we could be looking at 6,000, 6,500, around 6,500 by FY25 or so. So in my opinion, you can buy at current levels and on dip, especially around 3,500 looks very good to buy into. Look to hold for a couple of years to generate strong returns. I think if you can buy it around 34, 3,500, you can make around 80% on the stock. I think there's a very good possibility that the stock could head towards 6,000, and may just double from here in the next 3 years. So I believe 7,000 is a very good possibility over a 3 year period once things really get going, because whenever there is a rally in the market, that takes the stock higher quite appreciably in a very short period of time. It's a very good long term bet as well. If you can buy and hold over 6 7 years, can generate a lot of wealth. So yes, high PE stocks are getting hammered, but the stocks have already fallen a lot. A DMART is down around 45% from the top when it got to 3,200. I think between 3,200 and 3,500 would be good levels to get into the stock, and probably 27% CAGR is possible on the stock from 32 3,300 levels. So around 6,500 is a very good possibility, a distinct possibility by 2025 July. So in just over 3 years time, you could be looking at those levels, because in my opinion the mid and small cap rally should come back by next year, and it should find its mojo, and everything will go up, especially high quality mid cap stocks that have higher margins and higher moat will continue to perform much better, and you'll see fund houses or large, you can say, investors getting into such kind of stocks like DMART, and that will propel the stock higher only. As well as you need to understand that there is very low free float with higher equity with large investors or the promoters itself, 74 75% with the promoter, and the rest with very large institutional or large individual investors. There is only about 5 6% float that is available at the moment. So that is also going to play a part once the things reverse. So this is my video on DMART from a 2 to 3 year perspective. Please like and subscribe my channel and hit the bell icon so you can get my videos straight away when I post it, and kindly support me on Patreon. Thanks a lot for watching.